Good evening, everyone. Thanks for joining in for this webinar today. This is a webinar that Morningstar is conducting exclusively for AWS users. Given the long-standing relationship that many of you have had with Morningstar as such, so this webinar is being just conducted for all of you as such. And a quick introduction at my end before we get started. So I'm Dhaval Kapadia. I look after the investment management for Morningstar in India. And today what we're going to try and cover is obviously, some of the events that are unfolding, that have been unfolding over the last couple of months, in particular, the Russia-Ukraine crisis. And even prior to that, we've seen, towards Q3 and Q4 of last year, inflation concerns also sort of rising, particularly in developed markets, and creating volatility in markets and so on and so forth. So, today we'll try and talk about, some of these factors and how, in our view, they could impact markets and how they are impacting markets. And importantly, also follow that up with our views across different asset classes and talk a little bit about how, the portfolios that are in that position. And then, we'll open up for question and answers. So, I've got a brief presentation, so I'll just start sharing my screen and kick off from there. I hope my presentation is visible.
Yes, it is.
Okay, wonderful. Just before going to the core part of the discussion, I'll just talk a little bit about the investment management group within Morningstar. I know all of you would be sort of largely familiar with Morningstar, since you you sort of subscribe and use the advisor workstation as such. But the investment management group within Morningstar, to talk a little bit about it, is responsible for providing investment advisory and portfolio management solutions to clients, right, to investors, and we offer these by partnering with advisors such as yourselves, across different markets, and we offer portfolio management kind of services in the US, UK, Australia, South Africa, and in India we launched these services in April of 2019 or so. And we manage and advise about $260 billion plus worth of assets as such, and the group has invested quite significantly in building a large team of skilled sort of investment professionals, and that is obviously an important I would say foundation or bedrock for any investment sort of firm. So there are about 95 odd investment professionals within our global investment team as such, and as you would appreciate, these are people whose day-to-day job is to track markets, build views on asset classes, manage portfolios and review them, and so on and so forth. So fairly large team of investment professionals, and they are part of the overall group of about 550 plus people working within this group as such. And sitting out here in India, how do we leverage our global strengths and our global resources? So this is being done by the way the group is structured is into three regions, which are Americas, India, and Asia Pacific. And within each of these three regions, a center of excellence or a hub has been identified. So for instance, in Asia Pacific, we have a large investment team in Sydney, in Australia, and we work closely, and we, along with the other investment teams within Asia Pacific, work closely with the Sydney investment team to build solutions for the local market, right? And that's how we are able to sort of combine or bring together our local investment management experience with our global resources and our expertise as such. So that's how we leverage our global resources to deliver solutions for end investors as such. So just quickly changing gears and talking about what's been happening in markets on a year-to-date basis. Obviously, most equity markets worldwide are still in negative territory. India over the last week or so has recovered some of those losses, and in fact, if you look at the markets listed out here, Indian equities sit on top, with the large caps doing better than small and mid caps as such. this is just on a year-to-date basis, so from 1st of January to the 6th of April as such. Interestingly, there are a few things that one can observe out here is that, in terms of performance over the last about 3 odd months or so, is that, growth stocks or indexes which represent, growth stocks. So for instance, the NASDAQ or the S&P 500 growth, these have generally underperformed, value stocks. So the value stocks would generally include, the industrials, the capital goods, the traditional kind of, companies and sectors as such. So the growth stocks and, technology kind of stocks have underperformed, the value kind of stocks. So if you look at the S&P 500 value index, that is, probably, almost unchanged, just a marginal negative, whereas, the NASDAQ is down about 11% odd. The S&P 500 growth index is down about, 10.5% or so. Of course, Chinese equities continue to see further corrections. So they're down about 11% on a year-to-date basis. Obviously China is in a different, frame right now in that sense. Obviously we've seen regulatory crackdown and Chinese equities have been on a downturn even in 2021. So some of that has continued into 2022 as well. And of course, Russian equities are still down about 30 odd percent. Obviously, the way markets have moved is one is obviously the more recent crisis in Russia and Ukraine and the impact on commodity prices and concerns around growth and so on. But it has also been sort of from previous year, if you looked at what was happening to inflation already, those concerns were persisting, particularly in developed markets. Central banks in several countries had already indicated their inclination or to curb inflation and to raise interest rates to do that as well. So some of it is also a factor of what has been happening over the last 6 to 9 months or so prior to 2022 as well. And on the right hand side, you can see how the Russian currency has moved versus the US dollar at the start of the war in late February, early March. The Russian ruble did see a sharp fall. It corrected by about 40 odd percent versus the US dollar. But since then, and to many people's surprise as well, it's recovered a fair bit, and now it's almost back to the pre-war kind of levels. And probably this seems to be driven by the fact that although there have been sanctions imposed on Russia, but as we know, they continue to trade with some partners, particularly selling oil and things like that to countries such as China and India as well. So where the currency of exchange that's being used is the ruble. So because of continuation of that, some of those trade factors as such has resulted in the ruble sort of recovering most of its losses during since March as such. So that's how markets are looking like right now. And of course, a lot of talk has been around commodity prices and the impact of commodity prices and of the war on commodity prices as such. But if you look at how commodities have moved since Jan 2020 is what we've sort of plotted out here. Since obviously once the vaccine discovery happened, we saw a sharp recovery in economic growth in major economies. We saw supply side issues try to supply not keeping up with the demand recovery as such, and which had anyways also resulted in commodity prices starting to move up, right? And that's what you can see. Even during 2021, commodity prices had already moved up, and they've now moved up further on account of the current crisis as such. So overall, commodities, major commodities since Jan 2020 are up 70%, right, which is quite significant. Out of which food prices are up by about 40 odd percent. Again, some of it is driven mostly by the recent trends as well. Industrial inputs and commodity prices are up by more than 50%. And natural gas is up by about 3.75 times, right, which is quite significant. And again, if you look at the graph, you'll see that the orange line indicates the movement in natural gas prices. Some of it had already happened in the second half of 2021, And then, in recent times, again, you've seen a further rise in sort of the prices of natural gas as well. Again, obviously, most of us will know that, Russia is a major supplier of natural gas, particularly to Europe and so on. So that's been sort of keeping prices elevated as such. And as a consequence of that, we are seeing concerns on inflation rise. And if you look at the right-hand side of this slide, you'll see that we split it into two parts. One is how inflation has been moving in advanced economies, since Jan 2021, and how it has been moving in emerging, major emerging markets as such. So if you look at the left-hand side chart first, you'll see that there is a dotted line in between, which stands at 2%. So essentially, most developed countries have an inflation target of around 2%, right? I mean, of course, many such as Japan have been struggling to even reach that kind of level. But in recent times, we've seen inflation spike in most of the developed economies. And, obviously, in the US, in the UK, and the Eurozone as well, you're seeing inflation rates which have not been seen for the last about 50, 40 years or so, way back in the 1980s, when you saw these kind of inflation rates. So definitely, inflation has been a concern, not just over the last couple of months, but I would say over the last about 6 to 9 months or so in particular, where central banks have realized that this inflation may not be transitory, so it may not necessarily go away very quickly. So therefore, many of them have got into action as such. We know what the Fed has been doing and what it is expected to do as such to try and bring down this inflation. On the other hand, if you look at how inflation has moved in emerging countries, it is a mixed bag. For Brazil and Russia, inflation has been much higher in recent times, whereas for China and South Africa, it has been, for India and South Africa, it has been more subdued. In fact, for China as well, and in India and China, at least, I think, as we all know, fuel prices are not fully reflective of what is happening in global markets in terms of crude oil prices and so on and so forth. So some of those pass-through effects will come through going ahead, and this is what I think the RBI monetary policy today also spoke of, and the governor spoke of at quite a bit of length in terms of the risks and concerns around inflation, as well as of course growth for India as well. So overall we are seeing inflation sort of start to moving up quite sharply, and this is what has raised concern across the world as such in terms of and got central banks into action as well. And why is this? Obviously, in more recent times, as we've seen commodity prices, particularly oil and so on, move up even further. And again, obviously, this is driven to a certain extent by the crisis that is brewing in Russia and Ukraine, and of course the sanctions that have been imposed by many of these, particularly by the EU and the US on Russia as such. Now, if you look at this slide essentially, and the chart out here looks at, gives a sense of, Russia's share of commodity production for, various commodities, across both industrial and agricultural commodities as such. And as you can see out here, and particularly in case of, petroleum, Russia, contributes about 16% of the world's, sort of petroleum needs. It is, it stands at number 2 behind the United States. Similarly, in terms of natural gas, Russia produces 22% of the world's natural gas, and again is the second largest producer behind the United States as such. So, clearly, Russia does play an important role in the commodity sort of space as such. And if you look at even the chart below out here, you'll see that commodities such as palladium, for instance, which is used in automobiles, Russia contributes about 37% of the global supply. And similarly, if you look at some of the agri-commodities as well, and again, this is being spoken of by media as well quite a bit. Many of them, Russia, in fact, Russia and Ukraine put together contribute about 20 to 25% of the world's, wheat as such. So We've seen many of these agri-commodity prices move up as well. I think wheat prices on a 1-year basis are up about 50-60%, at a global level. So, not just industrial commodities, but also agri-commodities as well. We're seeing, prices move up, partially driven by what's happening in Russia and Ukraine as such. And, just looking, coming, closer to India in that sense, and looking at, how all of this is impacting India as such. On the left-hand side of this chart, you can see, where India gets its crude oil from. Like, as we know, India imports about 80 to 85% of its crude oil requirements, but fortunately it is split across multiple countries, and Russia forms at this point of time a very small component of India's crude oil imports. About less than 2% come from Russia, at least. This was for fiscal year 2021. The major suppliers include Iraq, Saudi Arabia, other countries in the Middle East, and of course US and so on. So it is sort of fairly widespread, at least in terms of crude oil imports. But besides crude oil, another area of concern for India has been edible oil imports as such. So about 70% of India's edible oil import requirements are met from imports in that sense. And again, Russia and Ukraine contribute a significant chunk of those imports, particularly things like sunflower oil and so on. A large share comes from Russia and Ukraine. So that is an area of concern as well for India. On the right hand side, you can see how inflation has been moving, and of course, earlier today, I'm sure many of you would have tracked the monetary policy. You would have seen that RBI has increased its inflation forecast, and probably a lot of people felt that in February. Of course, it was the previous monetary policy was before the war sort of broke out, and at that point of time, RBI had forecasted inflation at about 4.5% for the current financial year, which has started from 1st of April. And a lot of people felt that maybe that inflation forecast was probably a bit of an underestimate. And of course, since then, we've seen a further sort of jump in commodity prices, and now RBI has raised its sort of inflation forecast to about 5.7%. So that's a significant jump from what we saw in the previous forecast as such. So, and in fact, for the first 2 quarters of the current financial year, they're expecting inflation to be about 6%, and probably after that, it is expected to sort of taper down a bit. Right now, of course, and today, importantly, RBI also took the first step in a way of normalizing monetary policy. Although they haven't changed their stance, but as we know, they increased, the reverse repo rate. In a way, or rather, they haven't increased the reverse repo rate, but they actually introduced a facility that was earlier available, but they've made that as the floor, which is called as the standing deposit facility, which is where RBI doesn't need to provide collateral if they are, pulling out liquidity from the system, from the banking system as such. So, that rate has been moved to 3.75%, and that is like the effective, floor for short-term rates or overnight rate. Is what that floor has been set from the earlier 3.35, which was the reverse repo rate. Now, the standing deposit facility rate becomes the floor in place of the reverse repo rate as such. So some of that action has already been initiated, and in fact, if you look at again just coming back to this inflation chart, CPI, as we said, is still relatively subdued, right? For once, we can say that in India, at least if you look at the CPI. The inflation numbers are lower than, say, in the US and so on. But the other area of concern has been, inflation that is being seen by, corporates and consumers of raw materials as such. So, which is indicated by the wholesale price index inflation, which is the blue sort of line out here on this graph. And for WPI, you need to look at the right-hand side scale. For CPI, it is the left-hand side scale. So, as you can see, WPI has been about 12% and has been elevated for some time now, and maybe a complete pass-through of higher prices that are being seen by corporates hasn't been fully passed on to consumers, and the concern is that as that pass-through happens, CPI could move up, even further as such. So, that's the bit on inflation. So RBI has clearly, raised their inflation forecast, and like I said earlier, that concern is now, obviously RBI has also reduced the growth forecast. So it's a bit of a sort of catch-22 kind of a situation where you have growth expectations being lower and inflation, being higher as such. Now, this is obviously what we are seeing in the short term, and what we are seeing in terms of how markets have reacted, how inflation is moving, and so on and so forth. Now, if you just keep that aside for the moment and just look at, historically, how markets have reacted, post these geopolitical events, right? So over the last even 20, 25 years, there have been several geopolitical events similar to the one that we are seeing right now. Of course, the extent to which these events impacted, people in those countries was much lower in that sense in many cases. But nevertheless, there were several events. Of course, you had the 9/11 U.S. terrorist attacks as such in 2001, and then you had multiple such events, including the Russia annexation of Crimea in 2014, the Iran drone strikes against Saudi Arabia, and so on and so forth. And if you looked at how markets reacted, post that, and I would probably ask you to just focus on the table on top rather than look at the graph. The graph is fairly sort of busy in that sense, but if you look at the table, it summarizes the graph below. You can see that generally over a period of about a year or so, markets have recovered. So here we're looking at the S&P 500 and how it has moved, post some of these geopolitical events breaking out. And we've seen that over a 6 to 12 month period, particularly over a 1 year period, markets have tended to recover, barring the period after the 9/11 terrorist strikes in the US as such. So out of 6 such events out here, on five occasions, the markets have generated positive returns over the next 1 year or so. So in other words, what we're trying to say is that there is a possibility that some of these factors might impact markets and the economy over the near term, maybe over the next year or two, but generally over the medium to long term, the impact might be slightly more muted as such. And so how are we viewing all of this, right? I mean, we spoke of what's happening in markets in terms of inflation and impact on equity markets and so on and so forth. So how does this impact, what is our view on various asset classes, and how do we build these views? So I'll talk a little bit about our approach first in terms of how we build out views, and then I'll talk about what our views are at this point of time. So typically, when we build out views across different asset classes, and just taking a step back, so generally, as I mentioned earlier in my introduction to the investment management group, I mentioned that we offer, portfolio management and investment advisory kind of services, across various markets, right? And most of the portfolio management solutions that we offer are in the form of multi-asset solutions, right? So as the name suggests, these are products or portfolio strategies that invest across different asset classes, right? Which would include equity, fixed income, very broadly, even REITs in certain markets and so on and so forth, right? And typically, we go about building views across different asset classes. So how do we go about doing that, right? So typically there are 4 pillars to this entire process. The first pillar is the absolute valuation. So essentially what we try and do is we try and look at how an asset class is looking like in terms of valuations and fundamental growth as compared to its history, right? So what kind of returns can we expect from that asset class over the next 5 to 10 years based on how its valuations are placed versus how it has moved historically as such. So the first pillar is to look at the absolute valuation of that asset class versus its history. For instance, if I'm looking at Indian equities today, I'll try and look at what are the valuations and how does that compare with historical valuations for Indian equities, right? The next pillar is relative valuation. Here we compare asset classes, similar asset classes within a certain group, right? So for instance, we would look at say Indian large caps versus mid caps and small caps, or Indian equities versus international equities as such. So similar asset classes on a relative valuation basis, relative attractiveness, how do each of these asset classes stack up? So that's the second pillar. The third pillar is confident indicators, right? And this is an important pillar as well. We think that we try and assess out here, and I'll talk more about each of these as we go ahead. But here we try and assess that what is the extent of, what does the investor sentiment speak about that asset class today, right? Is there evidence of extreme optimism or pessimism towards a certain asset class, right? Now, one classical case today of investor pessimism is Chinese equities, right? I mean, people have been sort of exiting Chinese equities. The returns are negative. People, the sentiment seems to be negative towards Chinese equities, right? So what do those indicators tell us? And typically, the way we see things is that if there is too much of pessimism, there is a chance that that asset class might be, undervalued or might be looking attractive, because there are many more people selling those assets. Then, there aren't too many people very keen to buy them very strongly as well, right? So that's how we try and look at confident indicators. And then finally, fundamental risk, right? I mean, what is the potential, what is the downside potential based on current valuations for that asset class? Is there a chance of, permanent loss of capital? So, these are the four pillars that we tend to look at when we are building views on asset classes. Now, looking at some of these pillars in terms of and how the views are standing out today, and where do we see opportunities, so to say. So, based on sort of, absolute and relative valuations, we try and, what you see on this chart here today is our expected, 5 to 10 year, return forecast or return estimates for, major asset classes, right? And we've just picked a few. The overall list is much longer as such in terms of where we pull out return forecasts. Another important thing to note out here is that these are real returns, right? So in other words, they take out the impact of inflation, right? So these are returns after inflation, so to say. And the reason why we do that is to make them comparable across different markets and different asset classes as well, right? Because in India, the inflation rates might be different as compared to other countries. So therefore, to take out that impact or to make them comparable, we take out the impact of inflation as such. So as of today, we think Chinese equities look fairly attractive, even after considering some of the fundamental risks that still linger, more regulatory crackdowns or slowdown in economy and so on and so forth. Even after considering those, these look quite attractive now. And in fact, over the last 1 year, that's the other thing that's there on this chart is that we're seeing, as of Feb end, how these return forecasts are looking like and how do they compare with the 1 year ago kind of a period, right? So if you look at which is the orange bar is for Feb 21 and the green bar stands for Feb 22 as such. So there's been a big jump in our return expectations from Chinese equities, straight from about 1.5% in Feb 21 to about in excess of 7% on a real basis as of Feb 22. So we think Chinese equities look fairly attractive. Among other sort of attractive markets, UK and Japan look reasonably attractive as such. Although the absolute level of real returns aren't very high at this point of time because valuations we think are still fairly rich in most markets as such. Similarly, Indian equities have seen an improvement in return expectations over the last 1 year, and this has been driven by we've relooked at our growth assumptions and we think growth in India could be better. So therefore, although markets have continued to move up, but our return expectations, although on an absolute basis are low, but they have improved over the last 1 year or so. On the other hand, if you look at the other end of the spectrum, US equities we think don't look very attractive. The return expectations are low, and although again because of the correction that we've seen out there over the last few months, these have improved, but they're still at a fairly low level as compared to sort of most of the markets. Now, what's driving these return expectations? I mean, how are we building, these numbers out, right? So there are, largely three components of the return expectation, right? And these are essentially earnings and cash flow growth. So what is the kind of earnings and cash flow growth that we are expecting from that market or that asset class over the next 5 to 10 years. That is one parameter. The second one is the dividend yields, right? And in fact, we refer to it as total yield because there is buyback yield also included in that. In developed markets, we see a lot of companies buying back stock. In India as well, you see that, right? A lot of large IT companies and so on buying back stock from time to time. So what is the kind of yield that you get from dividends and buybacks? That's the second component. And the third is the valuation factor, right? I mean, are valuations in are markets overvalued or undervalued? Now, in case we feel markets are overvalued, it would tend to reduce our return expectations for that particular asset class or market. Now, for instance, if you take the example of India out here, the light green portion indicates the growth expectation, the real growth expectation, again, inflation adjusted growth expectation for India, which is, as you can see, probably is higher than most of the markets. The dividend yield component is also positive, again, although it's lower than developed markets because dividend yields in developed markets tend to be higher, right? But if you look at the valuation component, because we believe Indian equities are still overvalued, it is having a negative impact on the overall return expectations. You see the dark green bar at the bottom, which is in negative territory. In fact, that's true for most major markets, barring China, right? So, in other words, we think most major markets are still relatively expensive, and that's pulling down some of the return expectations. Whereas in case of China, the valuation adjustment is actually positive. So we think Chinese equities are undervalued, and that's contributing positively to the overall return expectation as such. Now, those were the first two pillars in terms of the absolute and relative valuation. The third pillar that we spoke of was contrarian indicators, right? And I know this is a busy slide with a number of graphs, but I'll just quickly talk about this. So when we, as I mentioned earlier, when we're looking at contrarian indicators, what we try and see is that what is the investor sentiment, what is the market consensus saying about that asset class today, right? Are too many people chasing that asset class, or are they exiting, or are they pessimistic about that asset class, right? And we believe, as I mentioned earlier, if the way we view it is that if there are several investors, or if the tilt is more towards pessimism, then we would think that that asset class probably is looking attractive because more people are moving away from that asset class and selling down that asset class, so to say. So when we look at contrarian indicators, there are three parameters that we look at. The first is the momentum score. So this looks at the last 6 to 12 months market performance in terms of the returns generated from the respective equity markets as such. Now, here we plotted the momentum score for India and China, right? So which essentially indicates out here is if the momentum score is negative, it indicates that the market performance has been strong, right, in recent times. And but in this case, till about mid 2021, this score was pretty deep on the negative side. Both India and US were performing very well. I mean, the equity markets have generated strong returns. In recent times, we've seen some sort of corrections in markets. India, obviously, you've seen some bounce back recently, but till about February, March, early March, we had seen those corrections. So, this number was moving closer to the neutral level of 0. So if it goes into positive territory, it indicates to us that that's a positive signal for us, so to say. The second is the expectation score, which is at the bottom on the left-hand side, which indicates the earnings growth expectations for that particular market and how they compare relative to history, right? So are people very optimistic about earnings growth, or are they pessimistic about earnings growth? And what we've seen in India as well as in the US, that earnings growth expectations have been pretty strong, right? In India itself, over the next couple of years, the expectation is that earnings, say for Nifty or for many other large companies, would grow in the range of 20 to 24%, right? Which is significantly above what we've seen over the last few years, right? Generally, earnings growth in India has been in the range of 12 to 15%, and people are now expecting higher earnings growth. So therefore, this indicator is in a negative kind of a zone. The expectations, the optimism seems to be fairly strong. Of course, of late, some brokerage houses have started reducing their earnings growth expectations, but they're still, we think are still at a slightly higher level as such. The third indicator, which is on the top right-hand side, is the flow score, in a way which indicates what are the kind of flows that we are seeing, both foreign and domestic flows, towards to the local equity markets, right? And out here as well, of course, yeah, in 2021 or for a good part, we saw pretty strong flows. In recent times, we've at least seen foreign investors pull out money, but money from domestic investors sort of continues to come in. So this indicator is probably closer to neutral and just mildly kind of negative. Now, if you were to sum up all of these indicators, although the overall score, which is the aggregate score, has improved a bit in recent times, but it is still sitting in negative territory. So in a way, indicating to us that the markets are still probably optimistic, and they don't seem to be pricing in too much of the risk that could play out in the near term as such. And based on all of these indicators, right, where do our views overall stack up, right? I mean, we looked at return expectations over the next 5 to 10 years, both absolute and relative, how they've changed. We looked at the contrarian indicators as well. So combination of those factors and the fundamental risk as well, we aggregate or we combine them to form our conviction levels, right? So essentially, these conviction levels, are from on a scale of low going up to high. So as you can see, low to medium, medium and medium to high, and then high sort of conviction. If at all there is any asset class as such. So as you can see out here on top, you have on the left-hand side, you'll see that convictions for major equity markets and sectors, and at the bottom, the conviction levels for major bond markets. On the equity side, we think, as I was mentioning earlier, we think there are opportunities in some European countries such as UK and Germany. Our convictions are a medium to high out there. As we saw earlier, return expectations, at least we saw the numbers for UK, were looking pretty decent as such, and the fundamental risk would be lower. So although in case of China, the return expectation is high, but if we consider the fundamental risk, emanating from some of these concerns around regulatory crackdowns and so on, our conviction has been toned down a bit, and it is at a medium kind of a level. Overall, most markets currently, our convictions are at a medium kind of a level. On US equities, despite the recent falls, we think valuations are still rich. Our conviction has improved a bit, but it is still, at a low to medium kind of a level. We think there is still too much of optimism. The growth expectations are still very high, particularly for the big technology kind of companies. And we know those names, and we've seen, sharper falls in those stocks in recent times. But, our conviction is at a low to medium kind of a level. Looking at bonds very quickly, again, in developed markets, we think, the absolute level of yields, although they've again risen in recent times on inflation and central bank concerns, but, we think these yields are still at low levels, in the sense that if interest rates were to move up sharply, you could still, you could still lose, some portion of your capital as well, right? So, so our conviction on government securities, particularly in developed markets, is relatively low, not just government securities, but high yield as well. Whereas, our conviction on emerging market local currency debt, is medium to high. Countries such as India and so on, some of the others, we think, the local currency debt looks, fairly attractive as such. Just a little bit more on Indian equities, and looking particularly at how markets have moved. Obviously, we know the strong performance that we've seen in markets, and some of it has been driven by one is a bounce back in economic growth, but also the fact that over the last couple of years we've seen deleveraging happening in the corporate sector. We've seen banks reduce their level of debt, NPA levels in the banking sector come down, profit margins showing signs of improvement, debt equity kind of ratios, which is a reflection of deleveraging, also is sort of improving. Interest coverage ratios also improving. So effectively, the expectation is that the corporate profits would grow, and that's what you'll see on this chart on the top left-hand side, which talks of the corporate profit to GDP ratio. Now, this had peaked in fiscal 2008, right, and at about slightly more than 5.5%. And since then, it was on a downward kind of a trajectory. But since FY21, we've seen an improvement in this corporate profit to GDP ratio, in a way indicating that corporate margins and corporate profitability would improve. And the expectation is, and which is what is indicated in the orange bars out here, that over the next few years, this ratio should start to sort of show further sort of improvement as such. And some of it is, as I mentioned earlier, is driven by a strong earnings growth expectation, and which is what you see on the left-hand side chart at the bottom, is that earnings growth expectation over the next couple of financial years is pretty strong. As I mentioned earlier, about 20 to 24%. Some of it is now being scaled down, on account of higher commodity prices and their potential impact on margins of companies and so on. But we think that a fair bit of this seems to be priced in, right, in terms of the optimism. Now, if you look at valuations based on whether it's 1 year forward P's for the Nifty or the 1 year forward price to book ratio, which is what you see on the right hand side, the dotted line indicates the long term average in both of these charts, and valuations, despite some of the recent volatility and corrections, are still above their long term averages, both in terms of the price to earning as well as the price to book kind of ratio. So clearly we believe that more of the optimism seems to be priced into the stocks. The risks don't seem to be fully considered at this point of time. So how do we translate these into sort of actionable sort of solutions, or where investors and advisors such as you can sort of participate as such? So in India, as I mentioned earlier as well, we launched portfolio management kind of solutions in April of 2019, and the strategies that we launched essentially are what you see out here. So these are a bunch of multi-asset strategies, and as the name suggests, these portfolios invest across different asset classes, which includes Indian equity, fixed income, and international equities, right? So these are the broad asset classes that we invest into, and obviously, as you can observe out here, each of these portfolios is suited for a different investment horizon and a different risk appetite, right? So, for instance, somebody with a horizon of about 5 to 7 years and a moderate kind of a risk appetite, they can consider a balanced portfolio. And as your horizon increases and the risk appetite increases, the other portfolios in a way can come into play as such. Another aspect about these portfolios is that the asset allocation is actively managed, right? So, based on our views across different asset classes, as some of them we saw in the previous slide, right? Now, for instance, if you pick the growth portfolio out here, what you see on the donut chart are the strategic or neutral allocations, right? So, if we feel Indian equities are trading at fair valuations in the growth portfolio, about 54% will be allocated to Indian equity, 16% to international, and about 30% to fixed income and cash, right? But as we know, on many occasions, markets are either overvalued or undervalued, right? I mean, they generally don't trade at fair valuations for long periods of time. So you'll see, those swings on both sides as such. So, so typically, accordingly, our valuations will also, or rather, our allocations for these asset classes will also vary based on our views, right? So if you think Indian equities are looking expensive, we'll allocate lesser than 54% in the growth portfolio to Indian equities. And, the allocation to Indian equity in the growth portfolio can move in a range of 40 to 70%, fixed income 20 to 50, and international equity in the range of 0 to 30%. So that's how these allocations will tend to sort of move based on our views, across these different asset classes. Another aspect about this is that these allocations are further split into smaller buckets, right? So Indian equity is split into large, mid, and small cap. So separate allocations for large, mid, and small cap. Fixed income into cash, short term, medium term, and long term, and international equity into 3 regions, which is US, Europe, and emerging markets. So those are the 3 regions that we are looking at within the international equity bucket, not just US equities, but a wider spectrum of markets as such. So why all of these asset classes, right? We looked at all the broad asset classes, and then we said even within those other buckets as well. So this chart in a way depicts how various asset classes have moved or performed over the last about 10 to 12 years, right? So starting 1st Jan 2008, we've plotted down the calendar year-wise returns for major asset classes worldwide, right? And which are also, many of them are also available to Indian investors as such. So therefore, all the returns are also converted into rupee returns. So if as an Indian investor, you invested in US equities or European equities, what are the kind of returns that you generated from those markets as such, right? So, and again, this is a busy slide with a lot of numbers, but what we've done is to try and simplify the way to view this is you could, for each calendar year, the asset class that has performed the best is marked in a dark green shade, and the worst performing asset class is marked in a dark pink or a red kind of a shade, right? So for instance, if you look at 2008, Indian equities, this was the time of the global financial crisis, obviously. Indian equities, along with all major equity markets, saw a sharp fall. Fixed income did well during that year, so it is marked in a dark green kind of shade, right? Interestingly, there are 2 or 3 trends that you can observe out here, right? One is, it's very difficult to pick the winners and losers on a year-on-year basis. So it's very difficult to predict which asset class will do well in a subsequent year, right? So if you look at 2008, as we said, Indian equities was the worst performing asset class, but in the next 2 years, it was the best performing asset class as well. And then again, 2011, it sort of was the worst performer. So you'll see, these trends change from time to time, and it's very difficult to predict how they will perform in a subsequent year as such. Another interesting thing to note out here is that in periods when Indian equities haven't done well, right, several other global markets have done well at that point in time, right? So for instance, if you look at 2011, Indian equities were down about 26%, but US equities were up, 12% as such. Sorry, 20% in fact. And similarly, even 2013 is a similar kind of a case, or for that matter, 2019 as well. When Indian equities underperformed, but European equities did also fairly well. US equities also did much better at that point of time. So, in other words, that you see this diversion in terms of performance across different markets, and that is also an important thing to sort of make a note of. And finally, if you look at the CAGR performance, right? And this is from, like I said, 1st Jan 2008 till as of yesterday, right? You'll see that several markets have done better than India as well. So driven by US equities has been the best performing asset class, and Indian equities is somewhere in the middle as such, right? The other thing that we did is we also included a multi-asset portfolio out here, which is number 3 in this list, right? And this portfolio is like a 50-50 portfolio, which is 40% Indian equity, 10% international, about 45% debt, and 5% gold. So it's like a 50-50 portfolio. And as you can see, in terms of performance, it's not been as volatile, right? It's not been the darkest green, nor has it been the worst performing asset class as well. And if you look at the CAGR performance, it's done fairly well, right? In fact, it's done better than Indian equity standalone as such. So 50-50 portfolio doing better than that is pretty good, right? And if you look at the volatility as well as the drawdowns, if you look at the risk measures as well, as you can see, of course, equities, the standard deviation will tend to be higher. For the multi-asset portfolio, it has been much lower as such. And importantly, in terms of drawdowns, right? One is, of course, emerging markets, including India, have seen sharper drawdowns in periods such as the global financial crisis, or even in March 2020 at the onset of COVID. Emerging markets, including India, fell much more sharply. But other major equity markets, and as well as the multi-asset portfolio, saw smaller drawdowns on a relative basis as such. So, in other words, we think it pays to be diversified, and not just across Indian equity and debt, but also across international markets as such. And just quickly, maybe we've just got a couple of slides to go, and then we can open for questions. But just very quickly, we spoke earlier about how the allocations would be actively managed in the portfolios. So typically, how will the allocations change over time? So normally, when equity markets have disappointed and valuations are looking reasonable, we will tend to reduce our allocations to debt and cash and increase our allocations to equity, and vice versa. When markets have generated very strong multi-year gains and valuations are looking stretched, is when we will reduce our allocations to growth assets such as equity and increase the allocations to debt and cash. Now, very quickly, just looking at how the aggressive portfolio is positioned, right? I mean, we spoke about the views, we spoke about how the strategies look like at a high level. Now, just looking at the aggressive portfolio in terms of all the asset classes that I mentioned and how are the portfolios positioned at this point of time. So out here, the way we are depicting this is the orange bar indicates the neutral or normal allocation to that asset class or that sub asset class. And the green bar indicates the current allocation. So neutral is if we felt Indian large caps were fairly valued, we would have about a 48% allocation to large caps in the aggressive portfolio. And that's where it stands currently. We think large caps are probably not looking as expensive. So we are close to neutral. On the other hand, we think mid and small caps are looking expensive. So the green bars are lower than the orange bars. As you can see out here, mid cap about 11.7 versus 13. And small cap is also marginally lower than our normal allocation. Similarly, US equities, as we mentioned, our conviction is like a low to medium. So again, here the actual allocation is lower than the neutral or normal allocation. Whereas for debt, again on the equity side, we think emerging market equities are looking attractive. So we are slightly overweight emerging market and close to neutral on European equities as such. Debt, obviously, in aggressive portfolio is a smaller portion. But we think medium to long-term debt, given the higher yields and the term spreads being higher, we think are still looking fairly attractive as such. So just to summarize on the proposition as such, we think one is it's a start-to-end solution. So therefore, right from asset allocation to portfolio construction to managing and reviewing the portfolios, the fund selection, all of it would be done at our end. Secondly, you get the opportunity to sort of look at both our global as well as local portfolio management expertise to these kind of solutions. And finally, the lower costs that are associated with the investment management fees are fairly competitive and lower as such than some of the peers as such. And just to sort of summarize the overall discussion that we've had today, initially we obviously spoke about the Russia and Ukraine crisis and how that has impacted, investor sentiment, resulting in a fair bit of negative speculation. Although last couple of weeks, markets have been sort of trending, upwards, at least in India as such. But then, an area that we feel will obviously is clearly having a significant impact is energy prices, and that's an area that one should watch out for. But we also looked at how sort of, over a 12 odd month kind of period, how markets have reacted after these geopolitical events. And then the message that comes across is that, one should sort of stay calm and carry on and not make too many changes in their portfolios as such, just based on the current crisis. And then, finally, a long-term approach can help, guard against unwise decisions that may be driven by, short-term fears as such. And at least from our perspective, we think a fundamental and a valuation-driven approach, helps identify, the opportunity set and attractive opportunities at different points in the market cycle, and that's the approach that we follow at our end. So with that, I'll stop here and so I'll be happy to take questions. So do feel free to share, your questions on the Q&A, box, and I'll just maybe try and look at if there are any questions. Yeah, so there is a question around, the question is around, do the portfolios use, mutual funds or ETFs? So, currently we are investing into mutual funds through the direct plan route. We do have a mix of active and passive funds, right? So we have a couple of index funds as well in the portfolios on the equity as well as fixed income side. But we aren't investing into through ETFs at this point of time because obviously, one of the concerns with ETFs is that the secondary market liquidity at times might be low, right? So whereas there are index funds available where you can get, obviously a passive exposure at a lower cost as well. So then if you want to take passive exposure, we would at this point of time prefer to take it through index funds rather than through ETFs as such. So I think that was a question that had come from Ashish. Do feel free to sort of add any questions that you might have on the Q&A tab. Yeah, I think that there's another question from Prakash. What will be the impact of rise in interest rates in US or Indian markets, both equity and debt, right? So I think that's a key question. I think that sort of a lot of people are thinking about, and in fact, I would think that obviously with the rise in interest rates, there are a couple of things that happen. One is the cost of capital. Obviously, in those states, if interest rates in the US are they've already started increasing the interest rates out there, and as the rates rise, obviously the cost of capital will go up, and investors that are that take leverage positions or that are driven by that get impacted by higher interest rates, obviously they will start to pull out money probably from other markets, and that's what we've seen. Not just since March when the Russia-Ukraine crisis erupted, but even before that, we've seen FPIs or FIIs pull out money from emerging markets, including India, right? So clearly it's not very positive from equity, even if you look at a flow perspective, from a fundamental perspective as well. If you look at interest costs for companies will tend to go up, therefore margins could tend to come down. So that is a direct impact of higher interest rates. Similarly, on the fixed income side as well, we've seen investors that especially for FIIs and so on, and large institutional investors that use leverage capital to make investments in different markets. If the interest rates in the US are going to move up faster than in India, and the differential is going to reduce, right? I mean, of course, even today the 10-year yield in the US may be about 2.6, 2.7%, and India is about 7% or so. There is still a fairly wide differential. But as the differential narrows, you could see investors, pull out money. Again, we've seen even from debt markets out here, FIIs, of course, not as significant, not in very large amounts, but have been, pulling out money even in recent times. So it's higher interest rates is probably not, very positive for most corporates, barring sectors such as, say banking, which might benefit from sort of higher interest rates, at least in developed markets where the absolute level of interest rates have been very low for a period of time. But generally, it isn't very positive. But I would say markets don't necessarily wait for that action to take place, right? They would tend to price in, because even the central banks these days are more open to communicating their thoughts and the way they are looking at interest rate moves and so on and so forth, on monetary policy action. So, some of it already tends to get priced in, before the actual, rate hikes or actions take place from the central banks as such. Okay, there are a couple of other questions. So one is, there's a question from Rajiv around how do you plan to continue to invest in international funds with the RBI still not increasing? So that's still not increasing the investing limit. So so that's a clear challenge for us. So for the time being, we've been parking that the international allocation for fresh money that we receive, we've been parking that into liquid. We are exploring the ETF route for international investing, but even on that front, we've seen for instance firms such as Motilal Oswal have said that they may not really be from beginning of April, that is 1st of April this year, they may not be involved in market making for their ETFs. So the challenge with ETFs would tend to be liquidity. And because of lower liquidity, the pricing that you get on those ETFs, right? So it's definitely a challenge for us, and we are trying to explore different ways to take that exposure. But at the moment, unfortunately, the fresh money that we receive for the international portion is being parked into sort of liquid at this point of time. And as and when those limits open up, obviously we can go ahead with those investments. But for the moment, that's a challenge as such. Another question is around allocating investments in China and what our view is from a 3 to 5 year perspective. Clearly from a valuation standpoint, as you probably would have seen the earlier slide, the return expectations are pretty strong, right? Given that China probably among most major markets is more attractively valued. So in terms of return expectations, they look pretty strong. In fact, even when we adjust for our global equity research team recently did the study where they adjusted or they re-looked at some of their views on major Chinese companies, and even after adjusting for lower growth rates. So essentially they reduced their earnings growth rate expectations for many of the companies and their obviously top line as well as bottom line growth expectations. And even after that, the valuations are still looking attractive. So effectively, again, it's not across the board, but select companies are still looking fairly attractive in our view. So therefore, in terms of allocations, at least in our portfolios, we did add some allocation to Chinese equities a few months ago. It's not done well in recent times, but like the person asked the question, from a 3 to 5 year perspective or from a longer term, medium to long term perspective, we think Chinese equities are looking reasonably attractive. But in terms of allocation, I think that's key as well, is that how much do you allocate, right? I mean, because there are risks involved as well, right? You cannot deny those risks. And I mean, we know, the regulatory concerns, the government has such a big role to play in many of the sectors and obviously the regulations. So, one needs to balance those risks as well. So therefore, the allocation can be, small to begin with, but we think it looks overall an interesting opportunity from a, 3 to 5 year kind of perspective. So if there are no more questions, then we can sort of call it a day today. I'll just wait for a minute if there are any more questions coming through. Okay, there is one question on the chat. I'm unable to see the, okay, yeah, okay, yeah. There was one question from Arvind which had come in earlier, maybe I missed that. So the question was around that, does the current situation make a case for stagflation where inflation is increasing but growth expectations are getting cut by central banks? Yeah, I think that's the term that comes to mind, right? I mean, even when, if you watch the RBI's or the governor's comments today and what they spelled out in the monetary policy, they increased the inflation forecast and they reduced the growth forecast as well. So that seems to be the case, to a certain extent, that at least in the near term now. How far this will extend, one will have to wait and watch. But it seems to be a scenario where inflation is taking the front seat, and growth is like taking the back seat. Even the governor also mentioned it today that in terms of prioritization now, inflation has moved up as compared to growth. So it is definitely an area of concern. But how long will obviously it will depend, not just one is the current crisis, but beyond the current crisis, as I mentioned earlier as well during the presentation, that these problems have been brewing for some time, right? You had supply side issues even during last year and so on and so forth. So at least, and you've seen a very strong growth bounce back in many economies as such. So therefore, the inflation concerns may not go away very soon, and that's what I think central banks are also recognizing, that this is not transitory, and the concerns could be a little bit more sticky in that sense. So yes, I mean that is a concern. To the point, the question that Arvind raised, that you could see a bit of that stagflation kind of scenario as such. I think that's all we have for today. I think there don't seem to be any further questions. I would just request you all to stay back for another couple of minutes to just fill in the survey, which will come in as soon as in a minute or so. So Abhinav, can we pull up the survey?
So the survey will come post we end the webinar.
Okay. So please hold on for a minute, and there are just a couple of questions that we would want your feedback on. So please complete the survey before you carry on as such. I think just before we do that, there was another question that came in just a minute ago, and I'll just try and address this before we conclude. Is that what is the future of digital assets? That question. Yeah, future of I mean that's. Of course, because of what's happening in Russia and Ukraine as well. I mean, of course, this is definitely a major topic of discussion, in terms of not just with relation to what's happening in Russia and Ukraine, but a bigger, conversation that's going on across, across the world as such. All major countries, central banks, governments are trying to look at the future of digital assets. So, but at least there seems to be a broader opinion that comes across. We look at, say even in India as well. The RBI as well as the government, particularly the RBI isn't, and which is quite natural, isn't inclined towards promoting private sort of digital currencies, right? So they do not think because obviously private currencies coming up, the central banks across the world will have no control over them, and that's definitely an area of concern. And if you recall, in the recent budget as well, the government did announce that the central bank will come up with its own digital currency. The RBI still hasn't spoken much about it, but then that seems to be the direction. At least one will have to wait and watch what other measures we know. The tax measures that the government took recently. Again, in a way, although they may not state it that way, but it seems to be in a way not a very encouraging sign for at least the private digital currencies as such. I think as we were speaking, there's one more question that's come in, so I'll try and quickly address that as well. Is that how should one position the debt portfolio as 10-year GSEC has crossed 7%, right? And I think that's the question that's coming from Arvind again. I think that's a very pertinent point that with concerns around inflation and interest rates and all of that, moving up. But the way, if you look at the yield curve, in India in particular, right, the 1 year, say the 1 year treasury bill or 1 year government security is typically trading in the range of about 4.3 to 4.5, 4.6% or so thereabouts, right? Whereas the 10-year GSEC is at about 7%, and today it crossed 7% or so. So if you look at the term spread, so we refer to this spread, which is the difference between the shorter end and the longer end of the yield curve, as a term spread. Right now, this term spread, obviously if you calculate it, it comes to in excess of 2.5%, right? So we think this spread looks quite attractive. In other words, and it's higher than historical averages. So historically, this spread has been typically in the range of 125 to 150 basis points, right? And currently, as I mentioned, it's in excess of 250 basis points. So we think some of the risks, in a way, or concerns on inflation or interest rate hikes seem to be priced in at the longer end of the yield curve. So the shorter end hasn't moved up as much as we've seen a movement in the longer end. So therefore, there is a possibility that the yield curve might sort of flatten over a period of time, right? And so therefore, we think that the medium to long duration looks reasonably attractive. So, at least in our portfolios, as I showed you earlier, we are sort of marginally overweight the medium to long duration. So, one will need to balance the portfolio. It can't be all in one segment of the yield curve, but I think a balance between the shorter end and the longer end is the way I would, we would sort of look at it as such. So I think we've sort of addressed all the questions, and thanks for staying back. And I'll the survey will just come up in a few seconds. So do complete it before you leave for the day. So thanks for joining in, and have a good weekend.